The U.S. economy is facing a critical juncture as Japan, one of its largest creditors, divests from U.S. Treasury securities. This shift in investment strategy has broad implications for the U.S. economy, as the U.S. has seen a declining appetite for U.S. government debt. The U.S. has historically been dependent on foreign investors, but Japan has pulled back as a buyer, indicating a shift in Japan's investment strategy. The shift in Japan's investment strategy has far-reaching implications for the U.S. dollar's global status and the stability of U.S. financial markets, potentially pushing the U.S. economy to the brink of collapse. As of September 2024, Japan remains the top international investor in U.S. government bonds, despite significant fluctuations in its investment levels throughout the year. In March 2024, Japan held U.S. treasuries worth approximately $1.87 trillion, but by May, this figure had dramatically reduced to about $1.128 trillion, with a significant reduction of $22 billion in May and a $37.5 billion decrease in April. Japan's U.S. Treasury investments have a long history dating back to the post-World War II era. Initially, Japan's investment in U.S. Treasuries was minimal, reflecting the country's economic recovery phase and the re-establishment of its industrial base. However, as Japan's economy grew rapidly in the 1960s and 1970s, its accumulation of U.S. financial assets, including Treasury securities, increased significantly by the 1980s. Japan had become one of the largest foreign holders of U.S. debt, influenced by its vast trade surpluses with the United States. This trend continued into the 1990s and 2000s despite economic stagnation in Japan during the lost decade. Japan's divestment from U.S. Treasury securities could have significant impacts on the U.S. dollar and contribute to global dollarization trends. As a substantial holder of U.S. bonds, Japan's sell-off could lead to higher Treasury yields, which would in turn raise the cost of U.S. debt servicing, potentially diminishing the dollar's allure as a global reserve currency. The implications for U.S. financial markets and government borrowing are substantial, as elevated yields on U.S. Treasuries could heighten government borrowing costs, making it pricier for the U.S. to manage its national debt. This situation might necessitate allocating a higher portion of the federal budget to interest payments, reducing available funds for crucial public services and investments in infrastructure, education, or defense. Japan's economic strategy for divesting from U.S. and EU treasuries is driven by several factors, including unrealized losses in bond portfolios, significant depreciation of the yen, and the shift away from negative interest rates. This has led the Japanese Ministry of Finance to intervene in forex markets, often by selling U.S. treasuries to support the yen, which affects import costs and inflation. Additionally, Japan's shift away from negative interest rates is making local bonds more appealing due to rising yields and reduced currency risks. Japan faces broader economic challenges including stagflation and an aging population, and to address these issues, the country is reallocating investments to domestic bonds and initiatives aimed at economic resilience and growth. This could mitigate market volatility impacts. Divesting EU treasuries could be significant for the European Union, leading to increased yields and borrowing costs for EU nations, putting pressure on EU government budgets. This fiscal pressure could lead to more funds being directed towards debt servicing, reducing allocations for public investments in sectors like infrastructure and social services countries such as Italy and Greece. A substantial sell-off of EU treasuries might also usher in volatility within European financial markets, prompting investors to re-evaluate their asset allocations and causing disruptions across equity and foreign exchange markets. Recent currency developments in September 2024 have seen the dollar weakening after U.S. inflation data showed cooling price pressures. The U.S. Personal Consumption Expenditures (PCE) price index rose 0.1% in August, matching expectations of economists polled by Reuters after an unrevised 0.2% gain in July. The yen has strengthened following Shigeru Isa's win in Japan's leadership contest, and the central bank is on the right policy track with rate hikes thus far. Japan has significantly impacted the U.S. economy by spending around $23 billion to prop up the yen, which appreciated by 3% against the dollar. Bank of Japan Governor Kazuo Ua discussed currency moves in a meeting with Prime Minister Fukushima Wade, stating that they could have a potentially major impact on the economy and prices. However, U.S. Treasury Secretary Janet Yellen warned against currency interventions, causing the yen to trend down again. The U.S. economy faces several challenges, including inflation concerns, a slowdown in the job market, and high borrowing costs. The Federal Reserve maintains high interest rates to control price pressures, and the job market has shown signs of slowdown. The banking sector faces risks, with over 280 banks at risk of collapse and nearly $900 billion in total assets tied to commercial real estate. Government spending and debt management present additional challenges, with the U.S. Treasury borrowing $41 billion more than previously estimated, totaling $241 billion. The U.S. needs to sell $125 billion in 3 10 and 30-year bonds in a single week, and if demand isn't there, there's a real risk of bond yields spiking, which could be disastrous for the U.S. economy. The global economic implications of these developments are significant. The stronger dollar impacts global exporters by making their goods more expensive in international markets, which in turn affects the cost of intermediate goods imports, which are crucial for manufacturing. Countries like Germany and France import a subset of intermediate goods, with over 40% of their imports being inputs needed to make their exports. Conversely, a stronger dollar makes U.S. imports of raw materials cheaper, with 38% of American imports being intermediate goods. Trends towards dollarization in international trade are accelerating, with Russia and China almost dollarizing their trade with more than 90% of settlements carried out in their national currencies. This shift is also happening in other markets, as countries start to organize and negotiate bilaterally while everything is still priced in dollars. This move allows countries to defend against a stronger dollar, as they don't need to sell their currencies to acquire dollars for global trade. The U.S. strategy to maintain dollar strength faces increasing challenges, as it helps prevent a collapse by allowing the U.S. to finance its large deficits at lower interest rates. However, other countries experience higher inflation, making it difficult for countries that manufacture a stronger dollar to maintain their competitive edge. China recently executed a significant sell-off of U.S. Treasury securities amounting to $3.7 billion shortly after the Federal Reserve announced a rate cut. This decision has ignited intense speculation and debate among economists, policymakers, and investors worldwide. The timing and scale of this move have raised questions about China's motives, view on the U.S. economy, and potential ramifications for international finance. China's current holdings represent a significant decline from their peak levels in 2013, and its U.S. Treasury holdings reached a staggering $1.3 trillion, accounting for about 21% of all foreign-held U.S. Treasury securities. This gradual reduction over the years hints at a shifting strategy in China's approach to managing its foreign exchange reserves and overall economic relationship with the United States. The most straightforward explanation lies in the impact of the rate cut on Treasury yields, which could prompt large investors like China to reassess their portfolio allocations. As a major investor, China is constantly seeking to optimize its portfolio, balancing risk and reward. The rate cut may have triggered a re-evaluation of the risk-reward profile of holding U.S. Treasuries, leading to the decision to reduce exposure. In addition to immediate yield considerations, this sell-off could be part of a broader long-term strategy of diversification that China has been pursuing for years. This could involve investing in other currencies, increasing gold reserves, or even funding ambitious international projects like the Belt and Road Initiative by reducing its reliance on any single asset class or currency. The timing of the sell-off of U.S. Treasuries following the Fed's rate cut announcement has led some analysts to interpret it as a strategic move by China to signal its economic stance or influence the market. This action can carry messages beyond their immediate financial impact, such as expressing China's view on the trajectory of the U.S. economy or its perspective on U.S. monetary policy. It could also be seen as an attempt to exert pressure on U.S. policymakers, reminding them of China's significant role in the U.S. debt market. China's domestic economic needs play a crucial role in its investment decisions, and there could be internal factors driving the need to liquidate some of its foreign holdings. China might need to free up funds to address domestic economic challenges, support its currency, or inject liquidity into its own financial system. The global economy doesn't operate in isolation, and decisions made by major players like China often reflect a complex interplay between domestic priorities and international considerations. The geopolitical dimension of this move cannot be overlooked, as China's relations have been marked by increasing tensions in recent years, particularly in areas of trade and technology. While $3.7 billion is relatively small compared to China's total holdings, the move could be seen as a reminder of China's financial leverage in the global economy. It might be intended to send a message about China's ability to influence markets or express dissatisfaction with certain U.S. policies. The psychological impact on market participants could be more significant, potentially influencing future trading decisions and market sentiment. Investors and analysts worldwide are likely to scrutinize this move for hints about China's future intentions regarding its treasury holdings. Large-scale selling of U.S. treasuries by major holders like China could put downward pressure on the U.S. dollar, which plays a crucial role in global trade and finance. A weaker dollar could make U.S. exports more competitive but could also lead to increased import costs and potential inflationary pressures. Looking ahead, China is likely to continue its strategy of gradually diversifying its foreign exchange reserves, but dramatic shifts are unlikely due to the potential for self-inflicted economic damage. Instead, investors and policymakers will closely watch China's treasury holdings for trends. The recent sell-off of China's $3.7 billion U.S. Treasury serves as a reminder of the complex interplay between economics, finance, and geopolitics in our interconnected world. Emerging economies like China are playing an increasingly important role in the global economy, reflecting not just trade relationships and economic output but also in the intricate web of global finance. The COVID-19 pandemic has accelerated many of these trends, highlighting the interconnectedness of the global economy and the need for diverse, resilient financial systems. China's actions regarding its U.S. Treasury holdings are just one piece of this larger puzzle, reflecting both its growing economic clout and its strategic vision for its place in the world economy. The reasons behind this move are multifaceted, ranging from simple yield considerations to broader strategic goals and geopolitical signaling. While it is crucial not to overstate the immediate impact of this specific sale, it does highlight the ongoing evolution of China's economic strategy and its role in the global financial system. The U.S.-China economic relationship significantly impacts the global financial landscape, affecting interest rates, currencies, trade, and investments worldwide. Understanding these complex financial moves is crucial for investors, policymakers, and citizens. Huawei, a Chinese telecom giant, has launched its first flagship 5G mobile chip, despite facing a U.S. ban on advanced chip technology. This technological breakthrough puts Huawei back at the cutting edge of mobile technology. Only a handful of companies worldwide, including TSMC and Samsung, have successfully mass-produced 4-nanometer chips. This achievement comes despite years of U.S. sanctions designed specifically to prevent this from happening. In 2019, the U.S. government placed Huawei on an entity list, cutting them off from crucial American technology. This meant Huawei could no longer use Google's Android operating system or access other key U.S.-made components. In 2020, the U.S. tightened the screws even further, blocking global semiconductor manufacturers using American technology from supplying chips to Huawei. Despite Huawei's smartphone sales plummeting and their access to cutting-edge chips being severely restricted, Huawei's partnership with SMIC and Huawei partnered with SM, a Chinese semiconductor manufacturer, to develop this chip domestically. This partnership has achieved what many thought impossible, a 4-nanometer chip produced entirely by China. The Kirin 9000s, a 4-nanometer chip produced by Huawei and SMIC, is a significant technological leap that demonstrates China's mastery of complex manufacturing processes. This achievement is not just about raw performance but also demonstrates China's domestic semiconductor industry, which has been steadily improving its capabilities over the years. Industry insiders are predicting that Chinese companies could be producing 3-nanometer chips as soon as 2025, putting them neck and neck with global leaders like TSMC and Samsung. This development is a clear sign that the tech Cold War between the US and China is far from over. The US has been using its technological advantages, particularly in semiconductors, as a strategic tool to maintain its global dominance by restricting China's access to advanced technology. However, this 4-nanometer chip shows that this strategy might be backfiring. In other tech sectors, such as artificial intelligence, quantum computing, electric vehicles, and renewable energy, China is not just catching up but taking the lead. For example, despite US restrictions on selling advanced AI chips to China, Chinese companies like BU and Alibaba are making significant strides in AI research and development in quantum computing. China has claimed several breakthroughs, including quantum supremacy. The future of global tech is complex, as competition can be good for innovation, and the race between the US and China could lead to rapid advancements in various technologies potentially benefiting consumers worldwide. However, this tech Cold War also risks fragmenting the global tech ecosystem, leading to the emergence of two distinct tech spheres. One led by the US and its allies and another centered around China. This fragmentation is already happening, with China's firewall blocking many Western services in the semiconductor industry. However, this situation presents opportunities for both sides. It could lead to more diverse and resilient global supply chains, multiple viable alternatives around the world, increased investment in R&D and education, and breakthroughs in various fields that benefit all of humanity. For example, the race to develop more advanced chips could lead to more energy-efficient devices, helping in the fight against climate change. The US government has cited national security as a primary reason for restricting Huawei's access to advanced technology, which has not gone away. As a result, increased scrutiny of Chinese tech companies and potentially new measures aimed at protecting sensitive technologies are expected. The global tech industry is deeply interconnected, with many US companies relying on the Chinese market for growth, while Chinese tech firms have benefited greatly from collaboration with US partners. A complete decoupling would be painful for both sides, as seen with Apple, which has much of its manufacturing happening in China. As we navigate this new landscape, it will be crucial to find a balance between national security concerns and the benefits of global cooperation. We will need to develop new frameworks for international collaboration in tech development and regulation. In the long run, the impact of Huawei's 4-nanometer chip breakthrough on the global tech industry remains uncertain.